Every morning, hundreds of millions of people step into a small box, trust it completely, and are carried silently through the world's tallest buildings. They don't think twice about it. But behind that seamless vertical ride is the world's largest elevator and escalator company, one that has been quietly compounding for more than 170 years.
And the business model is genuinely beautiful in its simplicity. You manufacture the elevator and sell it once. Then you service it for the life of the building, often 30, 40, 50 years of recurring maintenance and repair contracts. That recurring service revenue is what makes this company so interesting from a financial standpoint.
Today on Charged Alpha, we're going deep on Otis Worldwide Corporation, ticker OTIS, the undisputed global leader in elevators, escalators, and moving walkways. It is a company whose name is literally synonymous with the product it makes.
Q1 2026 results just came in, and they tell a story of two very different businesses operating inside one company. Revenue beat expectations by $80 million. But there's an EPS wrinkle. Small, but worth understanding. Let's get into all of it.
Let me set the stage here. Otis traces its roots back to 1853, when Elisha Otis demonstrated his safety elevator at the Crystal Palace exhibition in New York. He had an assistant cut the cable while he stood inside the platform, and the safety brake held. That single demonstration proved the elevator was safe for mass adoption and changed how humans build cities forever.
For over a century, Otis was the dominant name in vertical transportation, eventually becoming part of United Technologies Corporation. Then in April 2020, Otis was spun off as a fully independent publicly traded company. So while it carries 170 years of operational heritage, it has only been on its own for 6 years.
Today, Otis has roughly 71,000 employees and operates in more than 200 countries. They have approximately 2.2 million elevator and escalator units under active service contracts. That is their maintenance and repair portfolio, and they install around 170,000 new units every year.
The company operates through two distinct segments: new equipment, which covers the manufacturing and installation of new elevators and escalators in construction projects, and service, which handles maintenance contracts, repair work, and modernization of the existing installed base. And right now, those two segments are telling very different stories.
New equipment is under meaningful pressure, particularly in China, which has been a significant piece of that segment for years. China's construction downturn hit the elevator industry hard. New equipment net sales declined 1% organically in Q1 2026. That's not a disaster, but it's a real headwind the company has been navigating.
But service, that's where the flywheel is spinning. Service grew 5% organically in Q1, which is actually above the historical 3 to 4% norm. And here's the core economic logic. Otis has 2.2 million units under contract, each generating recurring revenue year after year under multi-year maintenance agreements. That is an extraordinarily durable revenue stream.
And the detail that jumped out of this quarter's earnings: modernization backlog, which is upgrading older units with new technology, better controls, energy efficiency improvements. That backlog grew 30% at constant currency year over year. That is a massive forward indicator for high-margin future revenue as buildings age and owners invest in upgrades.
Headquarters is in Farmington, Connecticut, with trailing 12-month revenue of about $14.4 billion. The structural moat is powerful. Switching elevator service providers is a high-friction decision for any building owner. Proprietary parts compatibility, technical specifications, regulatory compliance, downtime risk, all of it raises the cost of leaving Otis for an alternative.
At the helm of Otis since October 2017 is CEO Judy Marks. She came up through defense and technology. She was president and CEO of Siemens Government Technologies and held senior leadership roles at IBM Global Services and Lockheed Martin before joining Otis. That is a very different background from a traditional industrial CEO.
And that background probably explains a lot about her focus on digitization. Under Marks, Otis launched the Otis ONE connected platform, IoT sensors on elevators that transmit operational data to the cloud, enabling predictive maintenance before breakdowns occur. That creates both service retention and premium pricing power simultaneously.
She has been credited with driving Otis's transformation from a traditional manufacturer toward a service-led technology company. The consistent share repurchases, the dividend growth trajectory, the international expansion in service markets, all of that happened under her strategic direction.
The Street has generally respected her strategic clarity, though Q1 results did prompt some pointed questions. The 1-cent EPS miss, 89 cents versus the 90-cent estimate, was small enough that most analysts looked through it, but it did raise questions about whether margin execution is fully under control given the new equipment headwinds. All right, let's dig into the financials. Starting with valuation, at $79 per share, Otis carries a market cap of approximately $30.7 billion. The trailing PE ratio is 22.3 times earnings. Forward PE on next year's estimates drops to 18.7 times, which is meaningful compression from the trailing multiple.
How does that stack up relative to where Otis has historically traded?
It's near the lower end of the historical range. Otis typically trades between 20 and 25 times forward earnings. At 18.7, the market is pricing in some near-term earnings pressure, largely attributable to new equipment weakness and China exposure. Price to sales is 2.13 times on a trailing revenue basis.
What about the balance sheet? There are some unique characteristics there.
Otis has negative book equity, about negative $4.5 billion. That sounds alarming the first time you see it, but the explanation is actually straightforward. The combination of the 2020 spin-off accounting and significant share buybacks since the IPO has pushed the retained earnings deficit below zero. Total assets are $9.5 billion. Total debt is $7.3 billion. Cash on hand is approximately $800 million.
So the balance sheet structure is really a function of capital allocation decisions, not operational distress.
That's the right way to frame it. On the shareholder return side, approximately $450 million in share repurchases in the trailing period, on top of a dividend yield of 2.13%, with an annualized dividend of $1.68 per share at a 42% payout ratio. Capital is coming back to shareholders, even with a leveraged balance sheet.
Now let's talk about revenue and income performance.
Q1 2026 revenue came in at $3.6 billion, up from $3.5 billion in Q1 2025, about 2.9% growth year over year. Importantly, this beat the street estimate of $3.52 billion by approximately $80 million. Service net sales rose 11%, which includes about 5 points of organic growth and 6 points of currency benefit.
But the earnings per share side was a different story.
Right? Adjusted EPS came in at 89 cents against the 90-cent estimate, a 1 penny miss. From a margin standpoint, GAAP gross margin is 27%, operating margin is 16.5%, and net margin is 9.4%. The compression is driven by new equipment mix. Those projects, particularly in China, carry thinner margins than the service work.
And cash flow, how does that look?
Free cash flow for the trailing 12 months is approximately $1.6 billion, with operating cash flow of $1.8 billion. Q1 specifically was the seasonally lightest quarter, operating cash flow around $270 million, and free cash flow around $230 million. Management maintained full-year guidance with adjusted EPS of $4.20 to $4.24. Overall, Otis's financial health is solid. Recurring revenue is real, cash generation is real, but new equipment headwinds and a leveraged balance sheet are legitimate watch points.
What does the street think about Otis as we head deeper into 2026?
The consensus is constructive. Out of 15 analysts covering the stock, 6 have buy ratings, 8 have holds, and 1 has a sell. The consensus price target is $100 a share. Against the current price of $79, that implies 26.6% upside. That is a meaningful gap between where the stock trades and where analysts think it should be.
So the average analyst thinks the stock is significantly undervalued at current levels.
Yes, but the debate is about timing and confidence level. The bull camp believes the service flywheel acceleration and modernization backlog conversion justify a re-rating. The bear camp thinks China new equipment stays depressed longer than consensus expects, which caps earnings growth and limits multiple expansion.
Any notable analyst moves after the Q1 print?
Several worth noting. Morgan Stanley and JP Morgan both maintained overweight ratings, expressing conviction that the service growth story is the structural thesis and the EPS miss is noise. RBC Capital and Oppenheimer maintained outperform ratings. Barclays upgraded Otis from underweight to equal weight, citing the service momentum as stronger than expected. Goldman Sachs held its neutral rating.
How did the stock respond on earnings day itself?
Otis fell approximately 2 to 3% in pre-market and early trading. The revenue beat provided a floor, but the 1-cent EPS miss and cautious commentary on new equipment margin trends gave sellers an opening. Most analysts characterized the sell-off as a potential buying opportunity, though there was no catalyst in the quarter to force a re-rating higher immediately.
On the bull side, let me lay out the bull case for Otis. The service flywheel is the foundational thesis. 2.2 million units under contract, each generating recurring maintenance revenue year after year. As the global installed base ages, both maintenance intensity and modernization opportunity expand organically. This is a structural growth story that operates largely independent of macroeconomic cycles.
And the modernization backlog growing 30% at constant currency year over year is the most compelling data point in the entire earnings release. Modernization is higher margin work than standard maintenance, and it's directly tied to aging building infrastructure in developed markets, a multi-decade secular tailwind. The conversion of that record backlog over the next 2 years is a high-confidence earnings driver.
Second bull point, the China bottoming thesis. There are early signals that Chinese construction activity may be stabilizing from multi-year lows. If new equipment in China recovers even partially, returning to flat to slightly positive organic growth in the second half of 2026, the operational leverage in this business would be significant. That recovery scenario is not priced into the current valuation.
Third, the Otis ONE digitization play. Connected elevators with predictive maintenance capabilities command premium contract pricing compared to standard maintenance agreements. Adoption across the 2.2 million unit base is still in early innings, meaning the pricing power and cost to serve improvement opportunity compounds for years ahead.
Fourth bull catalyst, capital return consistency. Otis has grown its dividends steadily, runs an active buyback program, and has demonstrated disciplined capital allocation since the 2020 spin-off. In a moderate growth environment, buybacks reducing the share count by 1 to 2% annually provide a mechanical earnings per share tailwind even if top-line growth is modest.
Now for the bear case. China is the central risk, and it is not a small one. China has historically been a disproportionately large share of global elevator installations, and the construction downturn there has proven both deeper and longer than many expected. If Chinese property developer activity does not recover meaningfully, new equipment could remain a persistent drag on revenue and margin for multiple years.
Second bear point, margin compression. At 27% gross margin, the business has limited cushion. Commodity costs, labor inflation, and foreign exchange headwinds all bite directly into the bottom line. The 1 penny EPS miss in Q1 was partly a margin story. Any further erosion makes earnings guidance harder to hit.
Third, the balance sheet. $7.3 billion in total debt with negative book equity gives Otis limited financial flexibility relative to rivals who carry stronger balance sheets. If interest rates remain elevated and Otis needs to refinance maturing debt at higher rates, interest expense creeps higher and reduces earnings power.
Fourth, independent service providers. In elevator maintenance, smaller independent service companies have been gradually gaining share, particularly on older out-of-warranty units where the original manufacturer's proprietary parts advantage is less pronounced. If these independents take pricing share on service renewals in key urban markets, Otis's service margin expansion thesis gets harder to execute.
And finally, the EPS miss, while small, is worth monitoring. A 1-cent miss on a 90-cent quarter is about 1%. Not catastrophic, but it signals that cost management and pricing execution need close attention. Any negative earnings revision on the full-year guide would be more consequential given where the stock already sits relative to peers. Let's see how Otis stacks up against its industrial peers. The closest comparables in the building technology and services space are Carrier Global, Johnson Controls, and Trane Technologies. None of them are pure-play elevator companies, but they all operate in overlapping installed-base service businesses.
On price to sales, Otis at 2.13 times, Carrier Global at 2.48 times, Johnson Controls at 1.85 times, and Trane Technologies, the premium name in HVC, trades at 4.82 times sales. Otis sits right between Carrier and Johnson Controls.
On revenue growth, Otis is growing at 2.9%, Carrier at 6.2%, Trane at 8.1%. That growth gap is part of what justifies the valuation discount, and it almost entirely comes back to the China new equipment headwind. If you strip out China's drag, Otis's underlying service business is growing at rates far closer to peers.
Trane's premium is particularly interesting context. Trane gets a near 5 times price-to-sales multiple because investors are aggressively pricing in the data center cooling build-out narrative, essentially an AI-adjacent tailwind that Otis does not benefit from. Otis's aging building infrastructure story is equally secular and arguably equally durable, but it doesn't have that same halo.
The key question: does Otis's 2.13 price-to-sales look more like Johnson Controls at 1.85, a discount to peers, or should it re-rate toward Carrier at 2.48 as service margins expand? That re-rating is the core of the bull thesis and probably worth 15 to 20% in additional upside from current levels if it materializes.
Let's look at the options market and insider activity for Otis. On options, implied volatility sits at the 38th percentile of its historical range, relatively subdued. This is not a high-drama stock from a volatility standpoint, and the options market is treating the Q1 miss as a friction point rather than a structural problem.
The put-call ratio is 1.05, essentially neutral with a very slight tilt toward puts, consistent with mild post-miss hedging. Call open interest has clustered around the $85 and $90 strikes, suggesting traders are positioning for a gradual recovery toward the Analyst Consensus target. Put activity has concentrated at the 75 and 77 strikes as downside hedges below the current trading level.
Insider activity at Otis tells a one-directional story over the trailing 6 months. 9 insider sells and 0 open market purchases. CEO Judy Marks, CFO Anurag Maheshwari, and other senior officers have all sold shares under pre-arranged Rule 10b5-1 trading plans, which are established in advance and don't reflect real-time bearish conviction.
That context matters. All 9 sells appear to be scheduled plan executions, standard diversification mechanics for executives with concentrated equity positions. The bulls note this is normal practice, not a bearish signal. The bears counter that with management publicly optimistic about the service transformation and modernization pipeline. The absence of any open market buying at a 26% discount to the analyst target is at minimum worth noting. Institutional ownership remains above 90%, which is constructive.
Let me bring it all together on the bottom line for Otis Worldwide. This is a structurally sound business at what appears to be a valuation trough, driven by a cyclical headwind in China that the market may be treating as more permanent than the underlying data suggests. The service flywheel is real, the modernization opportunity is real, and the recurring revenue model is one of the most defensible in all of global industrials.
The central risk is China new equipment. If it stays depressed through 2026 and into 2027, the earnings growth story gets meaningfully pushed out. There is no substitute for volume recovery in a segment that large. Service growth and buybacks can only offset so much. But if Chinese construction stabilizes even modestly, the operational leverage in this business is significant, and the re-rating case becomes compelling.
The one metric to watch above all else, service segment organic growth. If it holds at or above 5%, the Q1 rate, and modernization backlog conversion continues at this pace, Otis has a credible path to the full-year EPS guide and toward the $100 analyst target. If service organic growth decelerates toward 2 or 3%, the thesis weakens materially.
Financial health verdict, solid. The free cash flow generation is real at $1.6 billion trailing 12 months. The dividend is well covered at a 42% payout ratio. The negative book equity is a product of spin-off accounting and disciplined capital return, not operational distress. The balance sheet is leveraged, but the cash generation profile makes it manageable under normal conditions.
And to close, here's a quote that feels almost written for an elevator company. Zig Ziglar said, "There is no elevator to success. You have to take the stairs," which is wonderfully ironic for a company that literally makes elevators.
And it actually describes Otis the business, too. The patient compounding of service contracts, one renewal at a time, one modernization project at a time, is exactly that kind of stair-climbing approach to building durable, long-term enterprise value. There are no shortcuts.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities, no sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out.
If today's deep dive into Otis gave you a clearer picture of how to think about industrial service compounders, drop us a review wherever you listen. It genuinely helps more investors find the show.
That's going to do it for this episode of Charged Alpha. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.